Hey YouTube, this is Zach with Achilles Financial, and today we're going to be talking about why the yield curve inversion is important and why we want to watch it. This is something that we've been tracking since last year in terms of the bond market and yields, and I think that we're going to continue to see a huge influence in the effects of this on the broader economy as well as the stock market. Keep in mind that when we're looking at bonds and the bond market, this is something that is probably at least three times larger than the US equities or stock market. So we're going to continue to watch how this performance continues to infect the broader market. So what I want to highlight here is actually going to be down on the screen right here. You can see on the right hand side we've got the Treasury 10-year, and down below you can see that as of the end of the day, the 2-year yield had a yield of 2.36%. and the 10-year had 2.36%. So the question therein is, why is this important and why does this matter? And there's a few different things that I would highlight. One would be the assumption of risk. Keep in mind that these are sold and these are contracts that are given out. This is not like a stock where if the yield goes up and down, you'll get more or you'll get less. You are locking in your cash or your capital into a 10-year contract saying that you are going to get 2.36%. Well, some of the institutions that have the largest amount of holdings for bonds is going to be the financial institutions in the United States, primarily banks. What we can expect here is that because the 2-year is shorter, this is going to be the cost that banks have to fund to go out and grow loans, to fund deposits, to grow their risk. So if this is what they're using to fund the loans, then they would expect to get a higher return on investment on the longer term loans that they are issuing. However, because the 10-year yield is so low right now, because interest rates continue to be incredibly low, their cost of funds to make loans is going up, whereas the interest or the return on investment has not necessarily equaled that. What that means is that they are going to slow down, which could potentially, this is kind of why sometimes the yield curve inversion can be somewhat of a self-fulfilling prophecy, because they are going to slow down, that means the velocity of money is going to slow down, and institutions are going to then see some additional pressure on earnings because, again, there's not as much money in the system and there's not as much discretionary income. So I'm going to take us over to Fred database to showcase kind of what that looks like. The reason that this is so important is because in most cases, institutions are largely, or when we're looking at this, that 90% of the time, or maybe 80% of the time that this happens, a recession occurs within the next 18 months. So this is not something that we expect to see the results from directly overnight. But as you can see, in 2019, the yield curve inverted for a short period of time, where unbeknownst to this risk right here, we did see a recession in the early part of 2020, largely due to the pandemic. However, if we draw this chart out a little bit and we look what happened in 2008-2009 time period, you can see that before the great financial crisis, there was also a period of time where the yield curve was inverted, and we then saw the recession from early 2000 or Q4 2007 all the way through the end of 2009. So as we continue backwards, you can see that every time that there's that inversion, there is an accompanying recession, at least in the recorded time period. Now, what we also recognize is that during this time period, we are only looking at 3 recessions, and so to say this is a surefire thing, I would still highlight that we will most likely not see this impact necessarily this week or potentially even this year, but it is something to watch because it will have an impact on the financial institutions, and we also see a lot of other additional downward pressures in terms of economic means, such as very high rates of inflation, as well as continued expectation for supply chain distress. So this is what we're going to be watching going forward and see what this impact is going to have not only on the stock market, but also on the bond market. And I will continue to keep you updated on the channel here. So if you find this content helpful, please leave a like and subscribe. Thanks. Talk to you later.